What caused the rapid spread of the 1997 Asian crisis? Imagine a row of dominoes standing close together. When one falls, it causes a chain reaction. That's exactly what happened during the Asian financial crisis in 1997. It all started in Thailand, but it didn't stay there for long. The crisis spread across East and Southeast Asia in just a few months, causing huge economic disruptions. So, what made this happen so quickly? Let's break it down. First, many countries in the region had banks and financial institutions that weren't very strong. They had taken on a lot of loans, especially in real estate and stock markets. These loans grew faster than the actual economies, creating bubbles in property prices and stock values. When these bubbles burst, banks faced huge amounts of bad loans, which made the financial system shaky. Second, these countries had borrowed a lot of money from foreign lenders. They often borrowed in US dollars, and their currencies were fixed to the dollar at certain rates. This fixed exchange rate made their exports cheaper and more attractive to buyers. But it also meant that if their currencies lost value, they couldn't easily adjust the rate. When the U.S. Federal Reserve increased interest rates in the mid-1990s, the U.S. dollar got stronger. That made exports more expensive for these countries and caused investors to pull their money out, fearing losses. Third, when investors saw the financial problems and falling asset prices, they panicked. They quickly withdrew their investments from the region. This sudden capital flight caused currencies to devalue sharply and stock markets to crash. Because many countries had similar issues and were connected through trade and finance, the crisis spread fast from Thailand to Indonesia, Malaysia, South Korea, and the Philippines. Finally, governments and regulators weren't prepared. They lacked the tools and rules to manage such rapid capital flows and financial instability. This made it easier for the crisis to turn into a full-blown economic disaster, with some countries facing political upheaval as well. In short, the Asian financial crisis spread so quickly because of weak financial systems, risky foreign debt, fixed currency policies, sudden investor panic, and poor regulation. These factors created a perfect storm that turned a local currency problem into a regional financial meltdown. Understanding this helps us see how interconnected and fragile economies can be when faced with rapid shifts in capital and confidence.